Fantastic. Well, thanks very much, and good morning to everybody. Great to have you here again for our monthly instalment of our Ask Me Anything webinar. As always, I'm joined by my esteemed colleague, Tim Pilkington, this morning. G'day, Tim. How are you?
Good morning, Tony, or good afternoon. We've just ticked over. Good to see you.
Words which occurred to me as I introduced you with a good morning. Thanks very much, Tim. And how are things in your part of the world, mate?
Busy this morning, which has been great, but everybody's up and going and good moisture around the place and lots of stuff going on, which is great to see.
There's a pretty buoyant mood, I reckon, across the certainly the southern states at the moment. Things are looking pretty good.
If you go back 12 months right now, like we've got a full profile of moisture, there's good grass around most of the paddocks. There's still reasonable prices everywhere you go, and so it's we've got all the things we need in place to have a really good start to the year, which is great.
Yeah, no, fantastic. It's an exciting time. Ladies and gentlemen out there listening to us this morning, or sorry, this afternoon, if you'd be kind enough, if you can't hear us, there's a chat function on the Zoom software. If you could just put a Y in that if you can hear us. And also, please, as we're going through this afternoon's webinar, feel free to put in a question if you don't wish to engage formally on the video. Please put your questions in the chat function, and we'll get to those as we can, and we'll field those as is appropriate. Ladies and gentlemen, it's a pleasure to introduce to you this morning Sam Adigrati. Sam is the managing partner of Vostro Private Wealth. Good morning, Sam.
Morning, Tony. Morning, Tim. Or good afternoon, I should say. Sorry.
We'll get that. We'll get that straight as the afternoon progresses, I'm sure, Sam. And Sam, thank you very much for joining us here. So, folks, this is our fifth instalment of our monthly webinar, and we've invited Sam along this morning as an independent financial planner. And the reason why we've done that, just to sort of set the scene and give some context, as anyone in agriculture knows at the moment, we're seeing a really strong growth in the value of farmland across Australia. And it's been strong for 20 years, but the last few years has been exceptional. And so what we're seeing is largely farmers out there owning land which is becoming more and more valuable. Typically what we're seeing therefore is a strengthening in the balance sheet, greater asset value, improved equity position because the debt isn't necessarily growing at the same rate. And that has proposed or has provided potential opportunities to look at off-farm investment. I've had a number of clients in recent months sort of say to me, Tony, I'm not sure we're comfortable buying more land at these prices. I don't think it's sustainable. And even if it is, we're not sure we can make a dollar out of it at that price. And so those sorts of situations combined with what we're seeing as historically really low interest rates still prevailing in the market have led us to see an opportunity to discuss some of the non-farming opportunities which may help farmers to use a strong balance sheet to try and continue to grow their wealth and provide an income outside of necessarily just farming more country. What have been your thoughts, observations in that space, Tim?
I think the main thing we're seeing in conversations, Tony, with clients is just sometimes it's just the inability to go and buy a block nearby, or as well as the caution around pricing of land and where it's at the moment. Are we due for a pullback, or is it going to keep going? And my crystal ball is just not very good on that. But the opportunity is there with the balance sheet to actually try and grow wealth over time, and not lose the momentum we've gained out of the last sort of 2 years worth of reasonable conditions in some areas of Australia. And we've got an opportunity to get something going in the business, but we might not have the opportunity to buy land. So how do we continue to grow wealth so that when the time comes, we've got the opportunity to go back in and buy land or find other ways to achieve the business goals?
Yeah, thanks, Tim. And look, it's a discussion which seems to be broadening across the country as conditions return to more normal climatic or even wet climatic conditions. So it seems pertinent to have Sam along this morning. And Sam, thanks again for joining us. So, managing partner of Vostro Private Wealth, tell us a little bit about your organisation, Sam.
Yeah, very good. Thank you, Tony. Just in relation to Vostro Private Wealth, it's just a bit over 10 years old now. And I guess in my view, it was ahead of its time in relation to getting the structure right, i.e. we wanted to make sure it was very transparent, no conflicts of interest, etc., as we've seen through the Royal Commission over the last couple of years. Hence, we've set it up really like a doctor's practice or accounting firm where the practitioners own the business. So that was really paramount. So therefore, the advice, I guess, structurally and culturally is in the best interest of the client. So therefore, we do have our own license. So therefore, we're not really owned by any major financial institution, etc. It's not about the product. It's all about the strategy, get the strategy right and the advice right. So from that perspective, we're basically open to everything. We'll assess everything. And it's sort of really coming back to this personalised advice that's really imperative and important in delivering to clients. So therefore, they get where they want to go to in the short term or long term.
Yep. Fantastic. Thanks, Sam. And you touched briefly there on the Banking Royal Commission and the financial services industry. Appreciating we need to cover ourselves legally from any standpoint. This discussion needs to be considered general and in no way personalised advice. But would you like to just quickly share your disclaimer, Sam, so that you're in the clear as a financial advisor?
Exactly. Would you like me to bring it up? I'll just talk through it.
Over to you.
Okay, that's fine. So just in relation, before we get started, from a disclaimer point of view, it is general advice. So again, from our point of view, to provide personal financial advice, we need to know a lot more about the prospective clients. So therefore, today is just a general discussion. Please do not take anything as this providing personal advice to yourself. We do recommend that you go and see not just myself, but any registered Australian financial services license holder or authorised representative to receive personal financial advice. That's the legal police out the way. So thank you.
I'll put that out of the way. Thanks, Sam. And we shouldn't laugh. It is important. So anyway, Sam, we've all heard of financial planners. Tell us a little bit about what it is that you guys do.
So we try and keep it very simple because everything in life is so complicated. So in short, we just really get to know the client, and it's all about goals and objectives. So it's very similar to what you do from a farm business point of view. We do this from a personal point of view. So that's why it's personal financial advice. So really it's about getting to know the client, what's their goals and objectives, and then going away and putting a strategy in place, which may include investments, which we believe is in the best interest of the client, but also help them to attain their goals and objectives. So it's really about not just putting it in place, but also ongoing monitoring. As we know, things change, legislation changes, investment markets change, pandemics. So it's been very challenging over the last 12 months, but it's really about being transparent, very communicative with the client base, and also just speaking to them, touching base, because things do change. And we've noticed that over the last 12 months. People had different goals and objectives 12 months ago compared to what they've got now. So the strategy does change as well.
I think the important thing, Tony, is that when people are thinking about this, that they go and get proper advice from outside sources, because if you're like me and you've tried to do some trading and things in the past, you know it doesn't always end well. And so it's a very specialised field, and making sure you've got good advice and good people backing you up like you do all the other areas of your business, it's pretty critical.
Yeah. Call that a learning experience.
Yes. Expensive ones, but they're the best lessons, aren't they, Sam?
Robinson Crusoe there. We've all had a bit of a muck around and a dabble in various bits and pieces over the journey. And I think that's, you hit the nail on the head there, Tim. And that's been one of the reasons I was so keen to get Sam along to speak with us, Gustavo. Seen a number of farmers take advice from somebody who didn't necessarily know much about what they're investing in. And, no surprise, things didn't end up going terribly well. And, you wouldn't take advice about a new crop without speaking to your agro, or about an acquisition without speaking with someone like you or I, Tim, and nor should you in the instance if you're looking at investing outside of the farm. If it's not your field of expertise, get some help. And so that's a little bit about what today is about. So, Sam, in terms of the what we're hoping to discuss with you today is really, I suppose, about this idea of creating wealth outside of the farm business. Most of our clients and most of our listeners today are pretty successful farm operators. They've got strong balance sheets, and they're, by and large, really good at what they do. So we want to think about the sort of approach we might take if we were to consider investing off farm. Let's say people don't know much about it. They're as I say, they're good at farming. That's their comfort zone, and it's where they've made their wealth to date. What would be the starting point from your end in terms of how you might go forward from there?
Great question. So Tony, just in relation to the starting point is, again, coming to that point to getting to know the clients, really getting to know the most important thing is what they wanted to achieve. Like any good business, I sort of speak to clients and say, look, you're really good business operators, and we say as a family unit, you need to do the same. So obviously with a good business, you have very good cash flow, you maximize your asset position to attain that sort of profit margin. And then with the profit margin allows you to do whether reinvest in the business or reinvest outside, etc. So we say it's identical to personal financial situations. So i.e., from a personal point of view now, you want to make sure that you have adequate cash flow. Because if you don't have cash flow, then there are no options that we can assist with. If we do have surplus cash flow, how much is it? And then we say, okay, what are the options? So the options are quite varied. So I'll keep it very general today because it really depends on how much cash flow you do have surplus and the quantity. So therefore we can sort of ascertain what are the best options for you. So in relation to first point is ascertaining the cash flow. The second thing is discussing these options. So, I guess from a very simplistic point of view, we may just say the basic one is a savings plan and using the power of compound interest to save over the longer term. So i.e. whether it's your rainy day or runaway funds or holiday funds, is putting money away. Unfortunately, the rates aren't great. You're probably getting sort of 0s to 0.5 on cash. You're lucky to get a term deposit with a 1 in front of it nowadays. So people are sort of questioning this to say, okay, is there any better solutions for this cash instead of just leaving it there? So the options do open up. So for example, it's about making sure we talk about timeline. Timeline is very important and risk is very important. I'll just talk about the timeline question first is, of this money, how much can we actually put away and for how long? So for example, if clients are happy to put money away for, say, we call it the long term, say 7 years, 5 to 7 years, then we can sort of look at more growth orientated investments. What I mean by growth orientated investments are, I guess, shares or property, both international or Australian, direct, whether it's through managed funds, whether it's through ETFs or even direct to market. So there are sort of 4 generic asset classes, which are cash, fixed interest, property and shares. But under each asset class, there's a number of different industries. So for example, property, there might be residential property, farm property, commercial property, it might be listed property, real estate investment trusts. So I guess there is a purpose there. There are pros and cons with all those. It's just really what suits the client. So just with I guess, growth versus defensive, cash and fixed interest are classified as your defensive assets, whereas shares and property are the growth assets. So it really comes back to how conservative or how aggressive in relation to how we can allocate those funds. It doesn't have to be a one-off. So for example, when you buy a farm or buy a property, it is a big lumpy asset. So from a lumpy asset point of view, it's really, when you look at a risk, you say the timing risk of that purchase is quite high because you're doing it such a big investment at one point in time, whereby there is another option where we might do it on a regular basis. So instead of putting $500,000 or $1 million into some lumpy asset, you might decide to start off with 50,000. It might include, say, a spread of Aussie equities or managed funds, for example, and you might start on a monthly basis. You might decide, cash flow allowing, of course, say 1,000, 2,000, 3,000 to be invested on a monthly basis. So there are pros and cons. I guess one of the pro is that you're buying on a regular basis. What that means is that you're buying, if the market's going up, you're buying at higher levels and expecting future growth. Even if the market does dip down a bit, you're still buying at lower levels. So when the market does turn around, you will see the benefit of that strategy. And, you can almost see that similarly with superannuation, where you have people putting money in on a regular basis because of their SG. SG at a minimum, you put it on a quarterly basis. So you do have the everyday person putting money into the market, whether the market is going higher or coming down. So it's called dollar cost averaging, which is a very nice way using compound interest to start an investment plan, whether for yourself, children's education. So there's a number of different avenues you can use that sort of option.
So Sam, a number of our clients would, that's a really clear explanation of how you might go about it. Just want to pick up on the idiosyncrasies of many of our farming clients. I've got a number of clients who are pure cereal croppers. So their cash flow is really, really lumpy. They might have to fund everything from April, May through until perhaps December when grain starts coming off the header with no income at all. So they're going to preserve their working capital to go back into fertilizer, chemical, diesel, those sorts of things, labour and what have you. And not, so the idea of your drip feeding and a few $1,000 every month might be quite challenging for businesses in that position. Can we get a similar outcome if we were to say, let's look at it taking an annual position and continuing to invest, perhaps bigger lumps, but doing it annually rather than your, pay as you go sort of scenario?
Yeah, certainly. And it's the other benefit of that strategy is the flexibility. So again, you can defer it for a month, 2 months, 6 months, depending on the fluidity of the business, etc. So it does provide a bit of flexibility with the investment strategy. And I guess really, with any investment strategy, we also allow for the position where there is a bit of cash flow ups and downs.
Yeah.
In the event of the investment strategy, doesn't have to be 100% allocated to shares and property. We can have within it certain percentages of the ability to tap into cash or term deposits or fixed interest that are more short-term orientated. So that comes back to that sort of risk profiling and how do we allocate that dollar. So every dollar, how much goes to what asset class? And again, depending on the client's risk profile and macro position from a business point of view. Sorry, Tony.
There you go, Sam, sorry.
I was just going to the last option that I wanted to talk about is about incorporating debt. This is it's riskier. So whenever you incorporate debt, you are incorporating another risk element. So from that perspective, there is a number of different ways that you can incorporate debt. So for example, if I had $100,000 and I invested into the market, potentially there are providers there that you can not use your personal balance sheet or business balance sheet and use that 100,000, say, investment and borrow another $100,000. So that's what we call is a lump sum investing through a margin loan. The rates are relatively a bit higher than your, say, residential mortgage loan or an investment loan. As we know, the rates have come down significantly. So these strategies are now proving a bit more of interest because the cost of money is cheap at the moment. It really determines whether it's in the right benefit of the client if we do incorporate debt. Debt, as you know, increases your growth, but potentially also increases your risk of negative returns as well because you're multiplying effect. So from that perspective, it can be a lump sum borrowing. You can also use equity in real assets, so i.e. whether it's a residential property or a business property, to use that, which again, you'll get a cheaper rate. And long term, we're looking at sort of 7 to 8%, 9%, depending on your risk profile. And you can sort of automatically work out the rate differential. If you're borrowing at 2 and you can attain, say, 7 or 7.5, again, these are just the scale we're having. So there's a differential of about 5%. And, you want to make your money work. It's not just set and forget. The money's actually working. So you're not using your personal exertion on the farm. You're getting your capital to work for you. And if you can get 5%, 6% net without too many problems, I'd say that's a good outcome, not just short term, but when you include compounding, and that's where the real benefit comes in relation to that compounding effect of that strategy. And it doesn't have to be a lump sum. It can be also on a monthly basis as well.
Go on, Tim.
Sam, just wondering, obviously now we're sitting in a situation where the perception around farmland is that it's a fairly risk-averse investment. Although we've sort of, part of today's conversation is that it's gone up quite a lot and hasn't gone too far. But at the same time, the S&P 500's hitting all-time highs. Everything seems to be pretty top-heavy in a situation where maybe the production underlying that doesn't stack up with where the prices are at. How do you manage risk in this sort of situation? Because you're taking it from something we know and understand and putting it into something that we can't touch. How do we sit there and know that we can manage this so we don't end up in a situation where we lose quite a bit of money?
Yeah, no, good question. So managing risk is 90% of our job. So how do we manage risk? Firstly, it's like making any good investment. You need to really know the valuation of that investment at that point of entry. So from our perspective, we sort of get rid of our biases by buying research into our investment committee. So we run investment committee on a weekly basis. So by having external research as well as internal research, we, I guess, reduce the risk of that investment failing by having that external and internal research. Because like anything, it's about looking at, say, for example, say a Wesfarmers or a Coles is getting an understanding of how their business operates, what makes them really unique, and what is the future looking like. So, for example, through the pandemic, we've seen those sort of stocks really outperform, which are your more traditional stocks. But then you've also seen these sort of IT tech-based stocks really outperform because it's expedited their business model, where a lot more people are doing what we're doing over Zoom, for example. So from that perspective, that's the first thing, is getting very good quality research and internally looking at it and assessing it to see, okay, how is the valuation? Is it expensive or is it cheap? We're going to hold this like a property. So we're going to hold this growth investments for 7 years, 5 years, because it's going to grow over time through the cycles. The other thing is timing risk. So for example, as I sort of use that example with a lumpy asset like a property, once you buy it, you buy it. Really, you look back 5, 10 years, say, oh, at that time it may have seemed expensive, and over 5, 10 years, it's cheap. Yep. So for the investment market, it's really about that time, making sure that you're happy with the valuation, because over time, ideally, you want to sort of be adding to it. So that's the other benefit of the strategy, is that you can add to it. If it continues to grow and the market looks good, you can and the entry price is good, then you continue to build your exposure. Diversifications is another one, very important. So from our perspective, we love property. We include it in all our clients because it is part of their overall net wealth. However, we're always advising due diligence is diversify your asset base, because property has a certain blend, farmland has a certain characteristic. Each asset has different characteristics which you can take advantage of. For example, I love Australian equities because you can sell them today and it's in your bank account tomorrow. So if you need that sort of liquidity function, it's fantastic. I love Australian equities too because of the franking credits. So from a tax system point of view, it really helps to maximise your after-tax return through income, which is similar to your rent. So just think of dividends, rent as the same thing. So from that perspective, diversification is paramount with any investment strategy as well, to minimise that risk.
So you're actively managing this consistently for your clients. Effectively, that's part of obviously what it is you guys do, but you're actually in there. So it's not like, I suppose your perception is you go and buy one of those ETFs and you set and forget, and then you wake up in a real estate crash and go, oh, what have I done? But you guys are actually, that's how you de-risk it, is by being in there for your clients.
So from our point of view, yeah, it is a long-term investment, but it's not stagnant, because forever there's new opportunities popping up.
Yep.
Legislation changes, global markets change, therefore there's more opportunities out there too, which sometimes aren't for everybody, sometimes are for everybody. Again, we decide on the client's risk appetite whether it's right for them. as part of their overall sort of net wealth position.
Yeah. So Sam, it sounds like a fair analogy between what your sort of, or one side of your investment strategy, which is it is a medium to long-term investment, much like buying farmland. We don't tend to buy and sell it on the short term, and then having that diversity in where we invest our money. So if I'm a farmer, I might grow wheat, barley, canola, a legume, and have some sheep or some cattle or some diversity in enterprise mix. You're saying you might have some Australian equities, and they might choose half a dozen different sectors within the Australian share market, or you might even look at property and overseas shares and bits and pieces like that. So the strategy actually, it's been interesting listening to you talk, is really quite similar in some respects to farming, but with a different skill set in terms of understanding the pros and cons and managing the risk.
Spot on. Couldn't have summarised it better, Tony.
And so I guess I'm always looking at, we started the preamble, Savo, with talking about these strengthening balance sheets and the potential, due to the lumpy cash flow of farming, maybe the opportunity there, rather than to contribute little bits each month or each quarter or half year, would be potentially to use to strengthen the balance sheet with the rising land values to make a lump sum investment. Could you just talk a little more? You touched on it briefly before, Sam. How would farmers consider looking at that, and what are the things they really need to be concerned about?
Yeah. So again, it comes back to cash flow, Tony. So cash flow is key. With any investment strategy, you want to make sure that you can sort of run it. Obviously, if you are using borrowing, there's a commitment there to fund the borrowing. And then we look at, I guess, more detail in how to deploy those funds. I guess in relation to the deployment of funds, I'll speak about now sort of diversification and I guess provide some expectation of what sort of returns are out there. So what I might actually try and share my screen, if that's okay.
Sure.
Okay. No, sorry, you're the host at the moment.
Hang on. Oh, okay. Apologies, Sam. Should be right to go now.
All right, fantastic. I'll just share my screen briefly. Okay. So just coming back to, I guess, just give you the viewers, if you like, an idea of what's happened. So, for example, this is an index returns to the end of February this year. So it's very relevant. And you can see this is what we're talking about, why we need to diversify, similar to the businesses, similar to your investment strategy. So, for example, I don't look at sort of short term, 1 to 6 months, very short term. You look at 1, 3, 5, and 10 years. So, for example, with the Australian equities, you can see that over the 1 year, even through the pandemic, you can see it's a positive 6.5%. But what's more important is the sort of longer tier term numbers, sort of 5 to 10 years. So you can see here, it ranges from about 10 to just under 8% over the last 10 years. Also, with the sort of global equities, again, these are indices. So you can see the S&P 500, you can see the MSCI World. 1 year, again, very positive, even through the pandemic, 8s and 9s. But longer term, all double digit. So we never say to clients that we can attain double-digit return because there is a lot of risk there. However, you can see why we sort of start blending different asset classes because they have different risk parameters. If you look at real estate investment trusts, the S&P, which is the Australian A-REITs, has had a very bad last 12 months. The worst asset class at the moment, minus 11%. What's in there? A lot of the sort of shopping centres, etc. However, long-term 10 years, you're still looking at sort of just under 10%. And then you sort of move on to the less riskier assets being fixed interest. You can see there that they're sort of running around about sort of really sort of negative to flat over the 1 year. However, 10 years in that sort of cash fixed interest type area of sort of 2 to 5%. So I just hope that this sort of gives you an idea of, this is historical data. So again, doesn't guarantee what's going to happen in the future. Disclaimer. However, it does give you a good 10-year history of what's happened in each asset class. So
it sort of compares reasonably well to farmland at 7% plus 4% cash yield returns. It's sort of there and thereabouts. Obviously, the last 12 months of farmland's been pretty hot. Might have been as close as 20%, but we don't know where it's all going to go effectively.
Yeah.
So,
I think that point that is also Sam's made is about that understanding timing, and it's not about buying on the cheapest day and selling on the dearest day. It's about being in the market for a period of time. Time in the market being more important than trying to time it. So, so Sam, if we might just change tack. So we've sort of talked so far about, potentially farm businesses who might be in that growth strategy and looking to continue to increase their wealth, by in a reasonably aggressive and potentially somewhat risky way. If we could change tack, please, and have a look now at superannuation, appreciating some of the same things apply, but let's say a family considering off-farm investment to provide succession. So let's say you have a son or daughter who might be coming back and looking to take over, firstly, management and then potentially ownership of the family farming assets. What role does superannuation play? And can you talk a little bit to super as a tool to try and provide a retirement, if you like, for perhaps mum and dad, which might make them financially independent of the farm?
We love super. So I know a lot of people hate super. We love it. I guess it's really coming back to having a really good understanding of superannuation, not just what you see on the media, but really get a good understanding of how it affects your personal net position, because it is a great retirement strategy, a la tax strategy for yourself as individuals, as part of that succession plan out of farming into transitioning to retirement and retirement thereafter. So I guess if I can briefly talk about the tax strategies inside super, just within, as you're accumulating wealth, we say there's 2 life cycles. There is potentially 3 life cycles. So really the first one is about accumulation. So you really want to accumulate, and given the legislation, they want you to start accumulating earlier to really maximize the benefits of superannuation. So from that point of view, while you're accumulating, an income is taxed at 15%. So if you earn $1 while in accumulation phase, you get taxed 15%. So therefore, you make 85 cents in a dollar. From a capital gains tax point of view, if you sell something and you make a gain, you've held it for more than 12 months, the tax is only 10%. So while you're accumulating, it's still very tax effective. However, the real, I guess, let's say the egg at the end of the time is around that sort of lump sum at pension phase or pension income. So when you convert that into a pension asset, everything, as long as it's within certain limits, which I'll talk about soon, it all comes back to zero tax. So when you earn $1 of whatever it is, dividend, rent, etc., you don't pay any tax within the superannuation fund. Also, capital gains, if you sell it within a pension phase superannuation fund, there's zero tax there as well. So now you're starting to see the benefits of superannuation and why, I guess, the strategy is always about getting the burden of an income stream from the government, and you've got to incentivize people to put money into that superannuation so they support themselves in retirement. And that's the taxation situation is very good. So that's why they've changed the rules recently. Sorry, Tony, go ahead.
Just want to pick you up on a bit of lingo there for those who are not as okay with this subject matter as you obviously are. When you say pension phase, the word pension immediately makes my brain flip to a government age pension. Yep. What you're talking about is not that at all. Please just clarify that for our listeners.
So this is when you turn your own superannuation fund into a superannuation pension. So you start a pension income stream from your own superannuation. A good example is, you may recall that turning the tap commercial, which some people may recall, where you sort of build up your super and then you turn the tap and it starts paying you an income to supplement your cost of living. So just to let you know also that the government recently have put a cap on it. So they're saying each person that holds a tax file number is limited to $1.6 million inside super to receive that tax benefit of zero tax environment. you can still have a bit more in there, but you still, over that amount, you're still taxed as accumulation fund, which is still tax advantageous as well. Irrespective, like from our point of view with superannuation, there's, I guess, 4 major participants or 4 options for you. One is, what's heavily advertised industry funds. Again, they're really good for a purpose. You have retail superannuation funds. You have sort of wrap facilities or employer funds, and then you have self-managed superannuation funds, which is a bit of, again, everyone will need to sort of review their own position as to which suits them best going forward.
And how much money will you need by the time you get to that when you want to retire, whether that's 45 or 75?
Yeah.
How much money do you generally need in the bank account to get you through? I suppose it's different at 45 to 75, but yeah.
Well, I think Tony's got a very expensive lifestyle, so that might be up at 100,000 he needs a year or something like that. But but everyone's different again. So some people can live off 40,000. Some people need 100,000. So I guess to give you a stat, the ASFA have come out and said normal, so average, we'll say average, for a couple to live in a comfortable retirement, is about $62,000 a year net. So again, depending on your situation, that will vary in relation to how much you need to live off. But using 62,000, that will vary based on how much you want to sort of make your capital work. So, for example, if you had $1 million in superannuation and you're able to attain, say, a 5% return, that means that's going to be earning roughly about $50,000. So, if you have 700,000 and you want to live off 60,000, that means you have to earn at least 8% to make the capital stay the same. However, just keep in mind that superannuation isn't supposed to be an estate planning tool. It's supposed to exhaust over the life of your life expectancy. So there will be times where it does sort of go up in value even when you retire, because the minimum draw isn't that great. And as you know, potentially, I'm not too sure, but as people sort of get older, 75 plus, they tend to spend less. However, the government is forcing people to take more out. So once you hit 75, they say you need to draw out 10% of the fund. Because of the tax advantageous position of superannuation, that they want to ensure that it comes out of the superannuation environment and goes out to, whether it's investing, giving to the kids or what have you, or even aged care at that point in time too. So that's sort of the life cycle of superannuation.
Yep. And so, Sam, I think it was Einstein that once quipped the most powerful force in the universe is compound interest. Super falls into that category, starting early, and the earlier you can get started, the more will be there when you need it, right?
Absolutely. It's I guess I've been sort of in this industry for about 20 years now, and the good thing is that we've got a lot more younger clients. When I first started, it was really around that sort of redundancy time, and people would be working in the same industry for 20 years, 30 years, and all of a sudden they retire. I was like, oh geez, what do I do now? The good thing now is that we are seeing a lot more people earlier on that are starting to really think about their future, because we have to. And the sooner you think about it, the better off you'll be for it too.
Yep. Okay. And a couple of questions have come in, Sam, from our audience while we've been online and in the weeks leading up to this webinar. The first one is from Kate Nelson. Not sure how you're going to grapple with this one, mate, but what off-farm investment opportunities would you recommend?
Again, that's I'll just say, like, the options are quite out there in relation to the number of options. So it really depends on your case, your family situation, your cash flow position, and therefore we'll be able to personalise that advice for Kate, I think her name was. So from that perspective, it really comes back to each personal situation as to what we would recommend. However, we can say, like, there is that breadth that we spoke about before, about whether it is that in that cash asset class, the fixed interest asset class, the property asset class, or the share asset class.
I suppose one of my questions around that, Sam, is how much money do you need? Like, if they're coming, is there a minimum amount that you need to start to make it worthwhile?
From that perspective, it really sort of, we promote a start. Like, I guess $10,000 is a start. It's really about sort of I guess once you know your cash flow, it really allows us to sort of map that out, not just the 12 months, but even longer, to give you an idea of the strategy and why it will work in your situation, given what we know, what happens historically, and what we will believe will happen in the future. So again, like anything, that whole saying is just that first step is the hardest.
So it doesn't just something like that to get things going, and then obviously if you've got more than that, if you've got 100 grand or 200 grand or 300,000, that makes life easier.
Yeah, spot on. And again, it comes back to that sort of why do you want to do it for?
Yep.
So it's that whole purpose of that strategy, and to have a strategy with a purpose is the end game.
It's interesting, Sam. I always see people, I think we started the discussion with that notion that for many farm business operators, farming is what they know, it's what they love, and it's what they're really good at, and therefore it's very much in their comfort zone, and not wanting to, perhaps stretching into something like off-farm investment might be beyond their comfort zone. I always look back and, I'm as you know, an ex-banker, and looking through my banker's lens, when you're going to apply for a loan from the bank and you've got this off-farm investment sitting there, which is worth, whatever it's worth, even if it's only worth, a few $1,000s, the fact that the farm has been able to produce a surplus of cash at some point, invest it somewhere and grow that, it's actually a really good news story on two fronts. One, it demonstrates that the farm's been able to do that. But secondly, if we want to look at the farm as being the protected species in all of this, which is a logical way if it's what you do and what you've been brought up and what you love, you have this other asset sitting there that if it all gets really, really hard, you can potentially liquidate that quite quickly, depending on where you put it, to help reinvest in the farm. What are your thoughts on that sort of line of thinking, Sam?
And that comes back to the flexibility of it. So again, things change from year to year, so it's about being nimble, flexible, but again, it's about really the communication with the client as to, okay, what's happening, how's it going. What you will find from experience is that you start off, say, for example, small earlier on, and then over time, the education, if you like, or the knowledge or the trust, all those things sort of start to develop. So the client is more accepting, knowledgeable of taking a bit more educated or calculated risks. And the knowledge becomes better about, whether it's Aussie equities or whatever, just in relation to the toe in first. And then over time, you'll be able to build it and you're able to spread it and take more risk on, etc. If you need 20,000 here, 50,000 here, that's fine. It's just about managing that cash flow.
Fantastic. And one last question from the audience for you, Sam, and I'm not sure how you're going to grapple with this one. What are your thoughts? It's from Tim Bradford from Deniliquin. What are your thoughts on irrigation water as an investment?
Very good. Good question, Tony. To give, I guess, an idea is that we have recommended for our sophisticated clients as a part of an overall agri position for non-farming clients. So without getting too technical, there is the retail arm and then the wholesale arm. Through the wholesale arm, we've been able to work with certain participants in providing an agricultural solution or investment for clients, which includes a portion of that is water rights. So again, coming back to the diversification, not in this solution, again, we believe it's too risky just to go one. We've had a wider spread of agricultural investments.
And how has that performed in your experience, Sam? Has it been worthwhile investment?
So this is a fairly recent one, a couple of years actually. However, they've got more historical data because they've been around for much longer. So again, it's coming back to, I guess, your original point. The farm is very much, when we talk about risk versus return. So historically, they've received equity-like returns for sort of fixed interest property-like risk.
Yep.
That's worked really well. So again, I'm talking to clients who don't have exposure like your clients, that we've introduced them to this asset class, which they couldn't previously.
Sounds like it's a worthy investment, but
I'm not giving personal advice.
No.
It's an interesting one. The question was also raised by Tim is, should I look at my water as an off-farm investment or an on-farm investment? And my response was, it depends whether you're using it on-farm to grow stuff or whether you're looking at it as a trading commodity like you would any other share or managed fund or something like that. So
I guess who owns it? Like, who owns it? Is it
Yeah.
the business asset or personal asset?
I think my takeaway from that, Sam, is you're sitting here as somebody who knows a bit about farming but knows a lot about investment, telling us all that there are investors out there coming into the Aussie water market, looking at that as an opportunity to invest and make a quid, when we've got irrigation farmers out there who potentially don't have that level of sophistication, certainly don't have that level of balance sheet strength playing in the same market. It's always concerned me a little bit.
Yeah, and that's the thing, isn't it? Like, I guess the old saying is, like, if you hear a stock tip from your taxi driver, that's the time to sell.
Sage advice, Sam. If that's the only advice we get, we'll hang on to that one today.
It's just general advice again.
Absolutely. Thank you very much, Sam. Thanks so much for your contribution this afternoon. It's been a really, really broad and valuable discussion. Could you just share with the group, please, your contact details should they wish to touch base with you?
Oh, okay. Now you're going to test me there.
It's
Sorry. I'll actually send them across to you if that's okay.
Yep, we will email those around in our follow-up and make them available on the website. So thank you very much. Sam, really appreciate your contribution today. And I'm, as I've said to you previously, really a firm believer that we're going to see opportunities to look at utilising and leveraging our balance sheets rather than just to buy more farmland. Maybe that's still a medium to longer term play, but to look at alternative investments to continue, as Tim said, to maintain the momentum, to continue to grow wealth and to create income. If, perhaps the current prices of farmland are a little bit off-putting for some of us, or we're not certain we can make a return in that space. And I think you've demonstrated that a number of points. If I could quickly summarise, one, where do it stick your money depends, and we can't answer that question without professional advice, really understanding your goals and objectives and your risk profile. And potentially you need to access that investment at some future stage, so your time frame. And secondly, that the range of potential investment opportunities is really broad, from really quite low risk and defensive type assets to really exposed and potentially high returning, but also equally very high risk assets. So again, using somebody like you with that expertise will help make good decisions and avoid the potential howlers. And I suppose the last point I've taken out of this has been the issue of timing. No time like the present, and the sooner we start to contribute, the sooner we get the benefit of that compounding effect over time.
Yeah, very good. And even if it is inside super or outside super, that's the other question, is getting this tax structure right. So, Tony, that's a very impressive summary, mate. I'm very impressed. So, thank you for the opportunity, and thanks, Tim. Thanks, Tony.
Thanks very much, Sam. Great to speak with you. Tim, as always, thanks very much for your contribution. It's been good to have your perspective and your points of contention in the mix as well. So much appreciated.
Beautiful. Thanks, guys, and thanks everybody for coming along.
Thanks, folks.
Thank
we'll
you.
See you at our next monthly instalment. And as always, the video footage of this webinar will be made available on YouTube channel. You can search that via Hudson Facilitation on YouTube, and also via our website and social medias. So thanks very much, folks. We'll see you next time.
Thanks, guys.
Thank you.